Good morning, everybody. Thank you for joining us. Today, we have Sarah Menchaca with Southern California Funding. She's going to talk about the loan process. She's had, I'll let her tell you her experience. I don't want to mess it up, so.
All right, thanks, Rob. Hi, everyone. My name is Sarah Menchaca. I'm wondering if I should turn on my video or,
Yeah, you can do that.
okay, so we're looking at myself talking. So actually, I have been in the business for probably over 20 years now, and I actually started working with Richard Moore when he was back in his business office. So at that time, just to have a little bit of knowledge of my background, I actually worked as a loan processor. And then I got my license, started originating loans, and then in between that, I also worked as a transaction coordinator. So I do have knowledge of both sides of the transaction. And so now primarily I just originate loans. But Carlos asked me here today to kind of go over the general loan process of a mortgage loan. So by any means, I don't expect you guys to be, experts when you leave here. This is just to kind of give you guys, general flow of the loan process. But, obviously you want to always work with a licensed mortgage professional to go ahead and pre-approve your clients. Okay. So with that started, I'm just going to kind of go over those slides. I'll kind of stop in between, for questions. We do have a lot to kind of go through, and I think we have about an hour. Is that right, Carlos?
Yeah.
So basically, this is the general order of what happens with your loan from start to finish. So in the beginning, we go through, and I'm going to go over each bullet point in detail, but we do a pre-qualification. We go to a pre-approval. At some point, an offer gets accepted. We submit the credit package to the lender. Once it's reviewed by an underwriter, we do receive the conditional loan approval. Once all the conditions are met on there, we do receive a final loan approval. Then the loan doc signing happens, and then we fund the wire is sent, and we do record. So I'm going to go in detail over all of these bullet points here. So the first thing we're going to talk about is the pre-qualification. So a pre-qualification, this is a very general process in the loan, and it's usually a verbal conversation with your client or with a buyer, and we're getting a general idea of what we can qualify for. So based off of their, their income, their assets, their credit, we're able to tell them usually within like the 10 to 30 minutes, this is what you can qualify for.
And this is just them telling you verbally, right? Not having any documentation, just telling you how much they make and what their credit is.
This is just verbal. It's very preliminary. And it's just to kind of get a general idea of what their situation is like. So a pre-qualification versus a pre-approval, they're two completely different things. And you always want to kind of know that when you are working with a client and you're asking them, have you been pre-qualified or pre-approved? There is a difference in the lending rules. Sorry. So in a pre-qualification or pre-approval, generally a buyer can use three different types of lenders. They can go to a retail lender, which is going to be like your Bank of America, your Wells Fargo, a correspondent lender, and wholesale broker. They're kind of the same where we work on the wholesale side. A correspondent lender, though, they're going to have their own money that they're going to lend. So what that means is that they're only going to have a certain amount of products that they can offer your client, where a wholesale broker is going to have a world of opportunity for your client. They just have more options to work with. The types of loans that a person is going to qualify for, you've probably heard of Fannie Mae or Freddie Mac. That's basically your conventional conforming financing. They're investors on the secondary market, and most loans that when a borrower applies for a loan, they're going to conform to their guidelines. So you're Fannie Mae, Freddie Mac. The government loans are FHA and VA, and then any alternative financing is going to be something that doesn't fall into those brackets. So this is going to be like your bank statement loan, usually for the self-employed borrower, a DSR loan. So this would be for your investor, where they're pretty much qualifying based off of the rents received from the property. So we'll kind of go into them in a little bit. And generally the pre-qualification and the pre-approval, when I talk to a client, it kind of happens during the same conversation. because I'm, getting a feel for them, what they can qualify for. And then at that time, we're gonna move on to the pre-approval. So the pre-approval, this is where we are actually verifying everything that the client has told us verbally. So at this point, I will be running their credits. I will be gathering all of their documentation, so all of their income and asset documentation, and actually reviewing everything. And I do feel that this step in the pre-approval process is really important. There are a lot of lenders out there that will just simply do a straight pre-qualification. And the issue with that is that they haven't actually reviewed all of the documentation. So say you're working with a client and maybe they're a commission borrower, or maybe a lot of their income is due because they're making overtime income. That is all looked at differently than what a base income is. Or say you're working with a self-employed borrower. They say, last year I made 200,000. The year before that, I made 150,000. But then you actually see their tax returns, and now after all of their write-offs, now maybe they only make 50,000. So it's really, really important that your client goes through the pre-approval process. A lot of them don't want to take the time to go through this because, they haven't found their house yet. They don't want to take the time out of their busy lives to get all the documentation up front, but it's really going to save you guys a lot of heartache and your client, because you never want to get.
I have a question. So have you noticed that with buyers that say that, oh, I make plenty of money, I made $300,000 last year, but they never took into consideration all the write-offs. So they're actually showing that they make $50 or $75,000. And then have you run across that where they're surprised that they don't qualify because I make this much money? It's like, yeah, you do, but this is how much the government thinks you make.
Correct. Yeah, I've run across those problems. I mean, Sally, I've actually worked with a client where they worked with another lender. They were halfway through their transaction. They had gotten a pre-approval letter. They were halfway through the transaction, and the bank was one of the retail lenders. They couldn't do it. They couldn't do the loan. So here he is. You spent money on the appraisal. You spent money on the home inspection. You're now getting close to your contingency period, or now your escrow deposit is going to be in jeopardy. And then you find out you can't get your loan approved. Like, no one wants to be in that situation. And luckily, we were able to do it because we do have lenders that were able to use like a 1 year's tax return, and we were able to add that. So we were able to save the file, but it would have been a lot smoother transaction had they, when they went through their initial lender, they went through that process at the beginning. So I generally only give out pre-approvals. I don't really give out a pre-qualification unless someone just really wants to kind of see what they're not sure where they're going to be moving at in the transaction. But when I work with you guys as an agent, I'm always giving them pre-approval. And I hope that you guys, when you're talking to your clients, you're preparing them for that, you understand the importance of actually having a pre-approval. So the list right here is generally what is needed when it comes time to do a pre-approval. So if you're talking with your clients and they're like, oh, I don't know if I have everything, here's kind of a general list of what you can give to them and what they need to collect in order to move forward with a pre-approval.
So their own credit report that they pull off their phone is not going to be sufficient, right? You have to run their credit.
I do have to run their credit, and a lot of times, you hear people like, oh, my Credit Karma report, or a lot of times, like their credit companies will give them like a generic credit report. The problem with that is that it's considered a retail credit score, and it's not all inclusive of all the debts that they have. We use a tri-merged credit report, so meaning we're getting 3 bureaus. We're taking the third or the middle credit score as a qualifying credit score, and it's all inclusive of what their credit history has been for the last 10 years. So we're looking at open trade lines, closed trade lines. We're looking at anything that's derogatory that's reported on the credit report, any inquiries that they've had, because sometimes depending on the timing, excuse me, if someone's going through a lot of inquiries and they're accumulating debt, it might not necessarily show up on the credit report yet. So if there's new inquiries on there, we are going to ask the client to address it and make sure that they have not obtained any new debt that's not shown up on the credit report. And as always, you guys have probably heard when a client is shopping for a home, until they close, they don't really necessarily want to open up new debt. And it doesn't mean that they can't, it just means that you want them to consult their loan officer. Because sometimes, you have a client like, well, I need to buy new furniture. I need a,
so you don't only look for 1 year, you said you look for 10 years.
Well, the credit history goes back
Okay.
for 10 years. There's some things that, like, you know, if they've had like a previous bankruptcy,
Okay, got it.
foreclosure, stuff like that will actually hinder them from getting certain types of loans. If they've had mortgage rates within like the last 2 years. So we do look at their full history. Mhm. But going back to someone who's looking to open up debt after we've already gone through the pre-approval process, you always want to ask them to contact their loan officer and go through it first. I've had clients where they're in the middle of the transaction and the lease is up and they have to get a new lease, they have to replace it. That's generally fine as long as they can qualify with that debt. And we do have to get the paperwork, we do have to get the lease agreement, so it does add more paperwork to the transaction. But if I'm approving someone and their debt to income ratio is the max, I'm approving them to the max of what they can qualify for. Them adding a payment, an installment payment to buy furniture or anything like that can actually make it where they can't get the loan anymore. So it's really important that they don't open up any new debt without talking to them. Okay, so after we've gone through the pre-approval process, and just so you guys know, the pre-approval letter is usually good for 30 days, and that's just because there's certain documentation that expires, like their pay stubs and their bank statements. The credit report itself is actually good for 4 months. The client that I work with, because I know sometimes it can take a client, 30 days to find a home. Sometimes it can take a client, I just closed one that actually took 4 years to find a place. So as long as your client tells me that nothing has changed as far as their situation, if they're like a straight W-2 employee, I'll continue to extend that pre-approval letter for them. And I won't keep rerunning their credit every 4 months until they actually find the property that they're gonna that they have an offer accepted. Because everyone is always worried about having their credit run multiple times. Okay, so now we're at the point where your offer has been accepted. And this is really when the clock has started. We're talking about contingency periods and what we need to have done within a certain amount of time. And nowadays, we're faced with shortened contingency periods because everyone wants to make their offer most attractive. So that is another reason why the pre-approval process in the beginning is so important, because now we've already kind of done half of the process. So we're already in a better position once that offer is accepted to move forward quickly. Okay, so in this time, we do have to provide the client with a loan estimate and order the appraisal. So those are usually the two most time sensitive issues right in the beginning of the transaction. We have 3 days as a lender to issue the loan estimate. And a lot of times we can't actually order the appraisal until your client has acknowledged and signed the loan estimate, that they received what the estimate of closing costs are going to be for the loan. So this is where it also helps when you're working with a good escrow and title company that are going to meet the fees, quickly. And then after we get this stuff, we're going to submit the loan to the lender. We're going to receive the approval. If it is a condo, depending on the down payment of your client and if the project itself is approved, we do have to go through a condo project approval. And then at some point, we do have to issue the closing disclosure. The closing disclosure is also another important document. It's like the loan estimate, but the client has to sign it a minimum of 3 days before you guys can even close escrow. So you don't want that to be a reason why your escrow is held up. So every lender has their own process of submitting their closing disclosure. The lenders I work with, we've had a really a fluid process where as long as we have like the appraisal, the HO or the homeowner's insurance quote, and the loan is locked, we can actually issue the closing disclosure at the time of the initial approval. So it's important because it can hold up transaction.
So, forgive me, so the closing disclosure includes what?
So the closing disclosure is actually, it's like your loan estimate. It includes all of your fees associated with the transaction. So basically, it's telling the client that your fees have not changed or increased since the time of your last loan estimate.
Oh.
Because, back in the day, there used to be like people would do like a bait and switch, right? So, they would say that they're charging one thing, you get to a closing table, and now your fees are, increased. So it's alleviated that problem.
And could things change, any type of fees or anything from the estimated to the final?
There are certain things that can change. I mean, for example, if someone wasn't locked in at the time of the loan estimate and then they walk in, before the zoning disclosure, that could happen. Sometimes, a change of circumstance could be, maybe the appraisal came in lower and now like the loan amounts are changing. Maybe now there's mortgage insurance, but it wasn't mortgage insurance. Some other ones I've seen is that, with the negotiations of repairs, maybe now, the buyer needs to pay for termite repairs to be done if the seller's not covering it. So not too often, but sometimes.
And then also for the appraisal, you said that you ordered like traditionally within 3 days, after 3 days?
No, I actually order it as soon as the client has signed the loan estimate.
Okay.
We have 3 days to give them the loan estimate, but we cannot order the appraisal until they've actually acknowledged and signed that they have received.
You can let them know that too? Like,
Absolutely.
okay. And then how long is it, are you seeing appraisal times, like after you order the appraisal?
Our appraisal times right now, I would say that they're pretty fast. Just I think because of the inventory that's out there. You can always order an appraisal on a rush. They will charge your client, it could be anywhere between like $100 to $200, maybe even $300. And sometimes it's necessary depending on how tight your is.
And are we talking about 3 working days?
Or the loan estimate, yes, 3 working days. Yes, so technically, any day that the broker is considered open is considered a working day. So Saturdays also count for us too, but not Sundays. So this is kind of what happens when the credit.
Can I ask you one more question on the last slide?
Okay.
Condo approval,
Yes,
is it because certain condo developments are approved? Some are not?
yes. So actually, Carlos brings up a good question. So condo approvals themselves have been a little bit more scrutinized from the lenders, especially since what happened in Florida. I'm sure everyone's kind of aware of what happened there. So Fannie Mae and Freddie Mac have a list of projects that have already been approved by Fannie Mae and Freddie Mac. FHA and VA, they also have the same thing. So when we run our file through the automated system, so Fannie Mae and Freddie Mac, they have an automated system where you run a file through. And when I went back to this list of what is required for a loan approval, when you run it through the automated system, sometimes you can get reduced documentation. So, instead of 2 years W-2s, maybe it's 1 year W-2. If it's a self-employed borrower, instead of 2 years tax returns, maybe it's 1 year's tax returns. So the idea of the automated system is it can, 1, alleviate the amount of documents that you need from the borrower. 2, it can also, sometimes you can get what's called an appraisal waiver, meaning that, this is on properties, you have $1 million or less when you're paying down 20%. The system is accepting the purchase price as the value, and we don't need to have the appraisal report. If it's a condo, on the DU findings or LP findings, it'll actually tell you what is needed for that project to be approved. Sometimes it's just a matter of getting like the updated master insurance, and maybe a few questions answered on either the appraisal report or like a limited questionnaire from the HOA company. And sometimes it can actually be like a full project review where we're looking at not only like maybe the 3-page HOA questionnaire, but now we're looking at the budget, we're looking at the reserves, we're looking at the CC&Rs. So that can take some time if you guys are working with a property like that. Not all the time, where you will have like a holdup or a hiccup for a condo project is if the project is in litigation. So as an agent, if you are representing the seller, you want to ask your client, is there any litigation I should be aware about that's going on with your project right now? As homeowners, they should know because the HOA management company has a duty to report that information to them. If you're working with a buyer, you should also be asking the listing agent, is there any litigation going on with the property? Most listing agents, they'll probably notate that in the MLS, but it's always good for you to, if it's not noted there, to ask, because maybe it's a newer agent and they didn't need to ask their client. Does that answer?
Yeah, thank you.
Not just for like condo projects that for the litigation thing.
The litigation is only effective if it's a condo project. We only care about that. Yeah. I mean, obviously, if it's a litigation on the property itself, if it's a single family home, depending where that resolved, it can be an issue.
I was wondering if like you had an HOA of like neighborhood and it has some sort of litigation, if that would matter.
Yes, it does.
Okay.
On a condo, or are you talking?
No, I mean like just like a normal single house.
No,
Yeah.
usually, no. Unless like the appraiser notes it in the appraisal report and then we become aware of it, then we might have to address it. But the litigations that I've seen, sometimes like the isolated incidents, like where it's between like a neighbor dispute, maybe someone's suing another neighbor because of noise. Generally speaking, if we get a letter from the attorney to state what the nature of the litigation is, something like that is not gonna affect the marketability of the condo, and we can generally move forward with it. Where there does become an issue is if there's structural defects. So a lot of times, I'm sure you guys have seen those plumbing checks out at properties, and a lot of people are experiencing like those painful leaks. If it's something like that, that's more serious because, it's just affecting this unit, is it affecting the whole association? So that could potentially be a problem. Sometimes slip and fall injuries or injuries that have happened at pools, it can or cannot be an issue. If the insurance company and the HOA company, and depending on where it is in the litigation, if they can state that there's enough insurance that's gonna cover, the outcome of the litigation, we can generally move forward. That's an issue where sometimes we can't get that letter because no attorney, if it's not settled yet, wants to say like, oh yeah, we're gonna pay up to this or up to that. So we do have lenders that will work with loans that are in litigation, but this does kind of fall to that alternative lending. So where it can be done, yes, but your client may have to pay a higher interest rate for that to go. Because interest rates, they are based on, I think my internet is.
Oh, they can still hear you, but you're just.
Oh, okay. The screen went,
Did you log
Sarah,
out?
no, it's just on my computer right now, it's saying connecting. Okay, I think I just do that. Yeah,
Oh, there you go.
okay. But I think I have to share my screen again now?
Yeah, can you connect to the 5G, the CVPP 5G? Not the regular one. That's probably why you disconnected.
Sarah, how about if the master insurance is not enough? So what happened in that case?
Are you talking about like if the HOA master insurance, that they meet the insurance requirements of the lender?
Yes.
So that is a case where, you might not be able to get your project approved and you would have to go to a lender that would deal with non-warrantable condos.
Okay, so the insurance is a key factor also.
Yes, and you bring up a great point, especially here in California with insurance, generally speaking, premiums are going up. Insurance companies are canceling insurance. And I have come across an HOA project where they were underinsured. They didn't have enough master insurance to cover the structure of the property. And we could not do it a traditional loan. We did have to go to a lender that did it as a non-warrantable condo. So yeah, those are all very important things to look at when you're looking at condos.
So non-warrantable condo also, they offer the conventional rate or just it's the hard money?
It's not considered hard money. It's just the loan itself becomes an alternative financing loan. And so traditionally, those types of lenders, their interest rates are going to be higher than someone that can go, to a Fannie Mae or Freddie Mac lender. And it's because it's based off of risk. Anytime a loan is priced out, the investor is going to base it off of risk. So even on a conventional loan for Fannie Mae and Freddie Mac, they'll lower your credit score, the least amount of down payment you're going to put on, you're going to see that interest rate going higher because it now is becoming a riskier loan. So same thing when a property becomes a non-warrantable condo project, that loan itself is now a riskier loan, and it is going to be reflected in the price. The interest rate.
Thank you.
Okay, so I think I was here at this point right here where the credit package is being submitted. So in the beginning of the process, the loan officer will do their initial review and they'll generate the pre-approval letter. In the same instance, we now need to have an approval come from the lender's funding writer. So we do that at the time when a property offer has been accepted, okay? So I'm pretty much giving them the same package that I've already looked at, but now I'm including everything that pertains to the property, purchase contract, the title report, the escrow instructions, you know, any HOA documents, et cetera. A complete credit package is going to go now to the lender's credit writer, and they're going to review the file. And then the next step is that they're going to give us what's called a conditional loan approval. So typically on a conditional loan approval, basically it's stating like, we're going to move forward with this loan on the condition that all of these conditions have been met. So typically you'll see like a verification of employment, the homeowner's insurance, the appraisal, the condo approval. Maybe they need some clarification on the borrower's income or their address history. Anything like that is going to be noted on the conditional loan approval. And it's the loan officer's responsibility to work with the buyer and the escrow and title, and sometimes the agents to make sure that all those conditions are being collected and met. Once we have all of those conditions, then we go in for what's called the final loan approval. Okay, so generally speaking, at this point, you know, all the conditions should be signed off on. When I review my conditions before I send them into the lender, I want to make sure that there's no question, because what I don't want to have happen is piecemeal, right? You send them a bank statement and now they're going to look back and be like, well, what's this deposit? What's this? What's that? So we, you know, a good loan officer will always try to screen everything. So that way, when it's received by the underwriter, there are no questions. It moves quickly. And then now we're at the final loan approval, because you want the final loan approval. This means that everything's been reviewed and signed off. There's nothing that's going to be, you know, holding up your loan. And we're going to be able to move forward and order the loan documents. At this point, your client should not get comfortable and start, you know, racking up debt or anything like that, because, or, you know, quitting their job, because the lender does reserve the right at any time between the start of the loan to the finish of the loan to re-verify anything that they need to. So they can, you know, re-verify employment. If they do have their credit run, the lenders do get notified. There is a system in place where it does notify them. So until that loan is reported, you want your client to still be on their best behavior.
Have you seen that happen where they call and re-verify everything?
So not myself, but when I was a transaction coordinator, I did have an agent that I was working with, and they lost their job the day that escrow was supposed to close. That lender re-verified deployment right before they were going to issue the wire, and they could not close.
Wow. Oh, no.
Yeah.
That's so sad.
So it does happen.
It does happen. It can happen. Yeah. You know. Unfortunately.
Yeah.
So until the last day, everything else kicked in.
Yeah, I mean, that, you know, that is on there, you know, and I've had it where, you have these conversations with your clients, you know, and then all of a sudden, like, that they will run credit, and you're like, wait a minute, you know, you get notified by the lender, you have to make your phone call to your client, you have to ask them what happened, and they're, oh, well, you know, it was 0% financing, and, you know, so we don't actually have a payment. Even if it's 0% financing, the lender is gonna look at it as the worst case scenario. That 0% financing, or, you know, no payment for like the next 6 months, that's not forever. They always have to go by worst case scenario. So then it can delay things, because now we have to get the paperwork from, you know, that new creditor, show them how much you borrowed, show them what the new payment is gonna be, and then provide that to the lender. And a lot of times we can't always get that in a timely manner, because if you've ever applied for a loan, sometimes it can take, what, like 20 days for you to get that paperwork in the mail to show what your terms are. So they need to be very careful not to do that. Okay. Okay, so now we're kind of at the fun part of the transaction, right? Where we're nearing the close of escrow. So after we've we received a final loan approval, And in between all that time, you know, we're gonna be issuing the closing disclosure, the lender's gonna be verifying employment, so there's a lot that's gonna be happening. Kind of like all at the same time, but now we're getting to the doc signing, so this is where the lender and the escrow company, they're gonna balance the loan documents. You know, they're gonna balance the final fees and let the borrower know how much they're gonna be bringing into escrow for the final funds. So you'll see here, the closing disclosure must be disclosed at this time. So where things can kind of hold up, our file on the real estate side is those last minute negotiations between the buyer and the seller. So when you guys are negotiating repairs, for example, you know, the buyer has a laundry list of what they want the seller to do. The seller's like, nope, I don't want to do it. So, you know, you're going back and forth, and now all of a sudden you're like, well, instead of all this, we're going to give you a credit of $5,000 for your closing costs. Okay. We need to know that before we draw loan documents, because if we don't know that and it's not on there, then now we're talking about redrawing loan documents. Okay, so I always, before I write a loan document, I always make that phone call to the agent. I say, oh, great news, you know, we're ready to draw a loan document. Are there going to be any more changes? Sometimes, yes. Sometimes they're like, oh, you know what, we're still negotiating. So I'm like, okay, well, let me know when you're done, because I need to know that dollar amount that's going to be for repairs. Or, you know, sometimes it could be like a rent back, right? You know, now the seller hasn't found a replacement property, or maybe their replacement property isn't ready for them to move into. So now we're dealing with a rent back, and they want that credit applied through escrow. Same thing, your loan officer needs to know that.
Or if an agent's gonna credit back some of the commission towards
Correct.
closing costs or something.
Yes, if you as an agent or an officer, yes, anything like that, we need to know. Okay. Because otherwise, if it's done after the fact, it is going to be a redraw, and that will incur extra costs to your buyer and time. Okay, so then, you know, here we balance, the loan documents are sent to escrow, and then the escrow company arranges a signing with the notary. Okay, but we're still not done. So after the loan document signing, there are certain documents that have to go back to the lender. There are some lenders out there that still want to do one final review before the documents are signed. So it doesn't happen too much now with the lenders that we work with, but occasionally there is like an older lender out there where they'll have it prior to doc conditions and prior to funding conditions. So sometimes what that means is that they'll move the prior to doc conditions to prior to funding just so they can get the file out and get the loan document signed. But they move them prior to funding, which means you still have to meet those conditions before you can fund the loan. The lenders that I work with, they want everything before we get to that point, so we're good to go. But if it's a lender that you haven't worked with before, you might just want to ask that question, okay? But regardless, the lenders that I work with, even though they don't really have too many prior to funding conditions, there are certain documents within the loan documents that have to go back to the funder to make sure that they're in a position to order the wire. So usually like the signed note, there's a list of documents that the escrow has to upload to the lender. And they're just really, it's someone there making sure that they signed everything correctly. Okay. Once that's done, then the escrow company will order the funds. And this is the funds that are being requested from the lender to fund the loan. So once they request that, that money goes to the title company. Once the title company receives those funds, then they set up a file to record. Sometimes it happens that same day. Sometimes depending on the county, you'll fund the prior day and then record the next day. But once you have, until you get confirmation of recording, nothing's final. So it's really important when you get that. Okay. So before we go on to the next part, does anyone have any questions? So the next part, this is new. I kind of created some cheat sheets that I think will help you guys with some questions that are coming up in the market these days. I do have a disclaimer on here that in no way are these cheat sheets, you know, use as means to either pre-approve or pre-qualify one of your buyers. Okay, so always, again, consult a licensed mortgage loan originator. Excuse me.
I like that.
this information I'm providing you is not for you guys to be experts, okay?
I just want to cover your bases.
Yes. And things are always changing. I mean, just as things are changing in the real estate industry, same thing with our lending industry, things are always changing. Guideline requirements, you know, such as how much you're supposed to put down, credit scores, so things are always changing. Okay, so this just kind of gives you a general idea of what the down payment requirements are. And this is just for purchases. I didn't get into refinances, cash outs, etc. But this will give you guys just a general idea if someone comes to you in an open house or someone you're talking to, well, how much do I need to have to put down to buy a house? You'll see here, and I have it highlighted by a conventional loan, a high balance loan, a jumbo loan, an FHA loan, or a VA loan, and whether or not the property is a primary residence, a second home, or an investment property. One thing that I do want to note on here is that if they are a first-time home buyer, they can do a conventional loan up to the conforming loan limit and put as little as 3% down. Here I'm giving you guys a cheat sheet of the loan limits. So, you know, we talk about conventional loan and a high balance loan. Okay, so they really have to do with the loan limit. So here in Orange County, you can get a conventional loan up to $766,550. Anything above that, up to a loan amount of $1,149,825 is considered a high balance loan. And then technically a jumbo loan is actually a dollar over the conventional loan limit of $766,550. The reason why it's important though is that there are different guidelines and requirements depending on if it's a conventional loan, a high balance loan, or a jumbo loan. And there are certain counties that don't have a high balance loan limit. And there are certain counties that their high balance loan limit might not actually be as high as what Orange County is. So this link right here actually breaks down what the high balance loan limit is from county and also from state. I only deal with loans primarily in California, but this link actually takes you to all the states and what their loan limits are.
So when you say like the limit, if someone wants to buy like a $2 million house and say they have like $400,000 now, they can't get more.
It just becomes a jumbo loan.
Okay,
So you have conventional, high balance, and a jumbo loan.
okay,
So jumbo loans, they're, it depends on the lender that you're working with. Like, for example, like my lenders will work with the loans where it has to conform to kind of the Fannie Mae, Freddie Mac guidelines are. So we still run it through this system. We're gonna get an approved and eligible, but that just means it's ineligible for the loan amount. And the nice thing about that is on a jumbo loan like that, we can usually go up to like a higher debt to income ratio. What happens on a jumbo loan with most lenders is that they have higher credit score requirements, and we'll get into debt to income ratio, and then lower debt to income ratio requirements too. So for a lender, it's important to know what loan you're qualifying your buyer on.
So that's what I was gonna ask. What's the difference between the conventional and the high balance as far as like documentation, or are there more fees or different interest rates?
Yeah, the interest rates can be different sometimes, and depending on the market. I've seen it where the high balance interest rates are better than conventional. I've seen it where the conventional rates are better than high balance. It does take into account the loan limits on that.
Any credits possible, the credit and the credit history or the,
Yeah, so like, I mean, even like when we were looking like here, you know, on a high balance loan, even if they're a first time home buyer, they have to put a minimum down of 5%. If they're doing conventional loan, then they can put a minimum down of 3%.
okay.
And then, you know, if it's a jumbo loan, then now you have to put a minimum down payment of 10%.
Sarah, would you please say in your last slide, what is number 3 and 4? Why is?
Yes, very good questions. So these have to do with the unit numbers. So if it's a 1 unit property.
Oh, okay, I got it. Thank you.
High balance. If it's a 2 unit, a 3 unit, and a 4 unit property.
Thank you.
Loan amount requirements. So the other question that I always get asked a lot is obviously, you know, what are the closing costs involved with a transaction? A lot of times the home buyers, they know how much they have to come in for a down payment, But closing costs and prepays, I don't think we get talked enough about, okay? For me, myself, I generally, when I have that conversation with my client, because I don't know what they're gonna pay for points. I don't know if they're gonna have an impound account. Sometimes they might just be thinking about it. So and are they gonna buy down the loan? What their actual costs are gonna be. So you can always say, like, as a general rule of thumb, depending on the sales price, it's safe to say about 2% of the sales price is what they'll need for down payment or for closing costs and prepaids. Okay. And there's obviously some fluctuation to that. But here you'll see that your closing costs, are going to be your escrow fees, title fees, your lender fees, if they're going to pay any points, reporting fees, notary fees, and then any miscellaneous fees here. It's not an all-inclusive list, but this is generally speaking what your traditional closing costs are going to be. Now your prepaids are different from your closing costs, okay? It's still required as to what you're going to need to come in with, like, your final funds to close. But a lot of the prepaids is what you're gonna pay anyways. It's not necessarily tied to getting the loan. It's just you're prepaying it. So your homeowner's insurance premium, the client has to always pay the first year's premiums through escrow. Okay. Prepaid interest. So that's the interest on the mortgage loan itself. So unlike when someone pays rent, if you're paying rent, June 1st, you're paying for all of June. Mortgage interest, it actually works in arrears. So when you're paying your June 1st payment, you're actually paying for all the interest that was due in May. So a lot of times you'll hear people say, like, oh, you're going to skip a month. You're not going to have a payment for the first month. You're going to skip a month. And basically what that means is, like, you're actually paying that interest through closing. So, like, if we were closing in May, you're paying part of that interest of May. So you're not going to have a payment in June because the lender already collected that interest in May, and now you're going to have a payment. The first actual true mortgage payment to lender is going to be in July. Okay. Additional prepaids are going to be if they decide to have an impound account, and then prorations for the property tax installments, and that can vary depending on when you guys close. Now, impounds can substantially add to the cost of what a buyer has to bring into escrow. Because depending on the month that you close, we could be collecting anywhere between 3 to 9 months of property taxes between what the seller's paying, what the lender's going to collect to reserve in your impound account. And so sometimes a client that I'm working with, their funds to close can be so tight, right? Where, yes, they know that they're going to have to pay those property taxes at some point in the impounds at some point, but they may not have all that money right there to do it. One nice thing to know is that the lenders that I work with, sometimes we do have the ability to waive impounds up to 90% loan to value. So that is a good selling point for your clients, where typically most lenders sometimes actually require an impound account if you're putting out less than 20%. In the state of California, if you're putting out less than 10%. But we do have lenders that if they meet certain requirements, we can actually get that waived. On a government loan, an FHA loan, unfortunately, no matter how much you put down, impounds are always required. Okay, so this is the other thing too. This is kind of like your cheat sheet for your debt to income ratio. So a lot of times clients are always asking, well, how much can I afford? Maybe they haven't gotten to the point of where they're talking to me. This is just a general equation for you guys to use, but I don't want you guys using this as your way of pre-qualifying or pre-approving a client, because that should definitely go through a licensed mortgage loan originator. But basically we're talking about two different ratios. We're talking about your front end ratio and your back end ratio. And they are different between, the program you're applying for, your down payment, et cetera. So your total housing payment is your principal, your interest, your monthly property taxes, monthly insurance, HOA dues, and mortgage insurance. So it's not just the principal and interest. When you're talking about total housing expense, we're talking about everything monthly in that equation. Okay. Your income, so this is going to be like your monthly income. So, for a W-2 employee, it could just be like their salary. Anything that's considered outside of someone's salary, so commission, overtime, bonus, and other fluctuating income is averaged, and we do look at it differently. But if your client's just trying to get a general idea just have them like use their salary income. Self-employed borrowers, we use the net income on their tax returns. And then when we're talking about debt, we're talking about typically anything that's gonna show up on their credit report. We're not taking into consideration like their utilities, their phone bill, like anything like that. It's just typically what shows up on the credit report. In some cases, we can exclude debt if it's paid for by their business, if they're a self-employed borrower or another party, but there are requirements that come into excluding debt, but there are options. So when we're,
I'm sorry, I have a quick question. Recently, sounds like a friend I just started doing, rent that gets reported to their credit. Because it's such like a short amount of time, like if you did it for like a year. And then wanted to buy a house, for instance, would they think that it was bad that he just started paying the rent like on his credit report, or would they view that as more like a positive thing?
so credit reports themselves, they want to see a 2-year history. And I'm not just saying like the lenders, but just to even generate a credit score. When you run your, the credit score, if someone has light credit or like light credit debt, their credit scores are actually gonna be a lot lower, like probably like 640.
Yeah.
And not because they're late or that they're not making their payments, it's just because that they have such small or shallow credit debt.
Yeah.
Does that answer your question?
Yeah,
Okay.
because I had a client that asked me also, like, that's doing leases right now. And she was like, if I have it reported for, like, to the bureau that I pay on time, like, does that, it improves her credit score, but does they view it as.
My lender, no, they won't do that. Because it basically, like, they're looking, when they're looking at the credit report, they want to see what the credit score is, and then they'll look at the credit history.
Okay.
So now, I mean, and it's the same thing, I mean, before, when we would have to come up with alternative trade lines as someone who didn't have a lot showing up on their credit report, we would actually send out what's called a verification of rent to their landlord to see like, okay, have they been making their payments on time? So it's almost kind of like the same thing, now it's just on the credit report.
Okay.
So when we're talking about a front end ratio, we are dividing their total housing expense, their monthly housing expense divided by their monthly income. And that's how we come up with the front end ratio. The back end ratio, we're taking their total housing expense, adding in all their monthly debt and dividing it by their income. And that's how we're coming up with a back end ratio. So typically speaking, on a conventional loan, if they have excellent credit that are putting like 20% down on a conventional loan, we can actually push that to 50%. Some lenders, like on a retail lender, they may only go to 45%. On a jumbo loan, sometimes some lenders may only go to 43%. So that is why the debt to income ratio is part of qualifying the borrower. Okay. On an FHA loan, sometimes they can push that figure up to 55%. On a VA loan, sometimes I've seen that number up to like 60. I remember the highest one I saw was like in the 60s, as long as they met residual income. So depending on the type of loan that they're qualifying for, there is going to be some variations as far as how far we can push our debt. Okay. And then let's see, how am I doing on time?
You're good.
All right, so I just want to briefly kind of give you guys some knowledge about points versus a buy down. Okay. So what are points? A mortgage point, sometimes also referred to as a discount point, is a one-time fee that you pay to lower your interest rate. Okay, so when your client's shopping around for an interest rate, maybe one lender is, quoting 7%, maybe one lender is quoting 7.5%. The buyer should always know what they are paying to get that interest rate. Okay, a good loan officer should be quoting what they are paying to get that interest rate. Sometimes they might not have that information, or sometimes they might see like a rate advertised on TV or a commercial, but there is fine print of how they came up with that interest rate. Okay, so see someone who's paying 7 or a rate quote of 7%, are they paying 2 points to get that interest rate? And then the rate quote of 7.5%, are they paying no points to get that interest rate? You always want to know, your client should know what they are paying for to get that interest rate.
So is a point typically associated with a percentage? Or does it vary?
One point is equivalent to 1% of the loan amount. So if the loan amount's 500,000, if they're paying 1 point, that means it's $5,000 that they're paying to get that interest rate. And to answer your question, there can be some fluctuation in that. It could be half a point, it could be 1.5 points. It just kind of depends on what the rates are doing at the time that they're getting a quote or that they're locking it in. The best analogy that I give my clients is like if you've ever looked at a stock market and you've seen, you know, this price of a stock is this, you know, in the morning and then at night it changes to here. Tomorrow it's something else. It's kind of like the same thing with an interest rate. Generally speaking, the interest rates stay the same. It's what you're paying for the interest rate that will fluctuate up or down.
So if it's 7%, you pay 1.1% to bring it down to 6%?
No,
Or how does that work?
no, it varies depending on the program, how the lender's pricing it out. I mean, I've seen interest rates that are actually lower that give a lower cost to the borrower just because that's the way that the lender wants to sell. So what you're talking about is buy down, and we're going to buy down. Yeah. So yeah, buy down. So buy down is the way that the home or a home buyer to lower their mortgage interest rate for the first few years of the mortgage by paying an upfront fee. So not necessarily an ARM. An ARM, you're kind of, you know, your rate is lower for a fixed period of time, and then it increases over time. And you don't necessarily pay the buy down to get that ARM rate. It's just whatever is being offered to you. So buy down, especially in this market, because the general consensus is that at some point rates are going to come down. You know, it's a shock from someone who, you know, was quoted maybe a 3% interest rate a couple of years ago to now they're getting quoted 7%. You know, the rates have almost doubled. And so it's kind of a way to have the buyer have like a lower payment in the beginning. And then maybe one or two things are going to happen. The rates are going to come down lower in the next couple of years, and then they'll be able to take advantage of a refinance. Or two, you know, a couple of years they're going to be making more money, and now that payment's not going to be as much to them. So how a buy down works, these are the options right here. You can do a 3-2-1 buy down, a 2-1 buy down, a 1-1 buy down, and a 1-0 buy down. And this tells you, you know, what the options are, and I'm going to go into some examples here. The reason why it is important for you guys to be familiar with this option is that when you guys are negotiating with the listing agent, if your buyer wants to utilize the buy down option, you want to be able to negotiate that with the seller in order to give some type of credit to your buyer to help them buy down the rate. Okay, and I will say that in this market, you know, depending, I mean, you guys know it better, you guys are the experts here, not me, and as far as, you know, working with like agents and negotiating. But, you know, it might have to be like the right scenario, the right house for it to work, you know, the right client, you know, if obviously your client offering this for buy down and someone else is offering the thing, maybe it might not work. But it's always good to utilize this because it can be used in a situation that you're gonna have. If you're working with buyers, they might even ask you about this. Hey, can we negotiate a buy down with the seller? So this is why you guys should know, or at least be somewhat familiar with it. So let me try to see if I can blow it up here a little bit. So on this scenario here, we're talking about a purchase price of 500,000. I mean, sorry, 800,000, a loan amount of 500,000. And let's just say, for example, the interest rate today was 7%. Okay, so you can see what the monthly payment is right here. And keep in mind that this monthly payment is not the total monthly payment. So we're talking about just principal and interest in this example. Now, if they do a 3-1 buy down or 3-2-1 buy down, that means in year one, they're buying their rate 3% lower than what the initial start rate is. So now the rate is going to be for the first year 4%. Okay, so you can see that the note rate, which is 7%, this is how much they should be paying, the $3,326.51. But because they bought their rate down for the first year to 4%, now their monthly payment is going to be $2,387.08. Okay, so they're saving, quote unquote, $939 a month. And this is, and the $11,273 is like the annual cost. Okay, year two, that rate is now going to go up from 4% to 5%. Okay, so again, you can see what the buy down mortgage payment is, what their savings is monthly, and then what it is annually. On year 3, now goes up to 6%. Again, we can see the buy down payment, the savings, etc. So when we do a 3-2-1 buy down, the savings that when you add up all 3 years, they're saving $22,927. So who pays that, right? That is where you negotiate the buy down from the seller. You give credit of that amount. Okay, that gets paid to the lender. The lender is now utilizing, so it's not like a negative amortization loan, right? Each month, the lender is still receiving the note rate payment. It's just coming from different parties, right? It's coming from the buyer, and then it's coming from the amount that they have in the buy down. Okay.
Sarah,
Yes,
excuse me, is there a cost for this, right?
correct, there is a cost, so that's the amount, the $22,927. So that's why I'm gonna go over different options, because I would say that it would be hard to get a seller to credit you guys that amount, right? So there are some options where you can do it where it's called an LLPA. So right here, it's a lender paid adjustment to pricing. So like, let's say that the seller's like, well, I only want to give you guys 11,000 for the buy down. Okay, so now what can happen is that there's the difference of the 11,500, and that can be paid for by the buyer to buy down the rate. So now it's coming from both sides. Okay, so there are other options. The 3-2-1 is the most aggressive buy down option. These ones tend to be a little bit more popular. So for like the 1 year buy down, so example for here, instead of paying 7% the first year, they're now paying 6%. The savings is $3,945, and you're pretty much asking the seller to give you a credit for that. One buy down means that for the first 2 years, they're paying 1% lower than your initial note rate. And again, this dollar amount right here, the $7,890, would be what the seller would be covering for the buy down.
Sarah, based on your experience, because it's a cost to each one of those, is it, so they have to buy it, so is it really worth it to go with this or no? Does it make more sense to go with the buy down?
Well, I think it really depends on the situation. So I think, for a situation where if there is a seller that's willing to issue some type of closing cost credit, do you want that closing cost credit to go towards your closing costs, or do you want it to go towards buying down your interest rate? And I would say every situation is a little bit different. Sometimes it's not even an option because the seller's just not giving you credit.
Yeah.
So this is just to make you guys aware that these options are available. If you do have a client that is asking you about a buy down, you now have knowledge in order to answer their questions accordingly.
Yeah. My
The
question
market and
is,
also the area. There's some areas, probably somewhere in Riverside County or something, that the
Right.
sellers might agree to something like this, but here, the way the market's so hot in South Orange County.
That's
Yeah.
what I wanna ask,
I
how
don't think that would
often the seller accept the, buy down?
So,
How long
so
does it have
I've
in
done 2. Some things have come out, I've done 2.
Oh, okay.
Yeah.
my question is that, is it buy down more makes more sense, or just buying a point, bringing down by a point?
Yeah, so when you pay a point, you're typically, depending on the market, you're only actually buying down the rate, maybe like an 1/8 or 1/4% lower,
I see.
For
Thank
the,
you.
dir- for the, for the entire loan,
but for the entire loan.
yeah. So long term, you'll save more money.
Correct. So that's what I'm saying, like there's a lot that kind of goes into it, if this makes sense or not. The ones that I'm seeing on where I've used them, it's just someone who they're not ready to make that monthly payment every month. They can qualify for it, they just don't necessarily want to pay an extra, $300-400 right now.
Yeah.
Um,
And of course, the higher the sale price, the higher those numbers are gonna be.
Absolutely. So, this is a very easy formula that I have. So if it's something that you guys are working with buyer, that you just want to run numbers, and it's also going to change too, depending on where the interest rates are that day. But I can run something like this that's more specific to your transaction. Okay. So that actually is the end of my presentation. So I can open up.
I have a question, it may be that I just missed something, but I get the whole debt to income ratio part of the qualification. But is there a multiple of earnings calculation that you use as a rule of thumb? So for instance, if somebody says, I've got this $1 million house I want to buy, and it's like they make $100,000 a year, they're not going to get financing for that, I assume.
Yeah, I mean,
Regardless of what their debt to income ratio is, it's the actual amount of money that's more relevant there.
right, so I mean, on $1 million property, it kind of depends, like, how much are they putting down, et cetera. If someone's making $10,000 a month gross, their typical monthly debt and housing payment should not be exceeding $5,000.
And use that as the.
So, and I say typical because, I mean, it could be a lot less than that. If they have really poor credit or, something else, just like maybe they don't have quite the stability in the job history part. I mean, it could be maybe like 45%. When I'm working with a client, I'm trying to push their, because everyone wants their debt to income ratios pushed nowadays because things are so expensive and you just want to know it from that. I run their file through the automated system, so I run it through Fannie Mae's or Freddie Mac's website. Make sure I can get that file approved at 50% debt to income ratio.
Thank you. So most of my house buying and selling experience has come back in England,
Okay,
and there the first thing that they ask for is salary, and then it's normally 2.5 to 3 times gross annual salary is
Yeah.
what you can qualify for a mortgage.
yeah, I would say like 45%, you're conservative, if you're taking 45% of their monthly income, as far as their debt and the mortgage. A lot of times what we can do right now is we can actually push that front end ratio, their housing expense ratio, up to almost the same as what their debt to income ratio is if they don't have any other debts. Does that make sense? Yeah.
See, who's still out there? Anyone else have any questions? Okay. Thank you, Sarah. Great job. Very informative.
Yeah, thank you.
And then we're gonna send out the reporting. A few of the agents were asking about the cheat sheets or the slides.
Yeah, that's
That-
fine.
Okay.
I mean, I would prefer that they're only used with you guys and not shared with anyone.
Just for knowledge, it'd be really useful to have that.
For
data
knowledge,
again.
absolutely.
I tried taking notes, but it was just too much to take.
And my contact information is right here. This is my cell phone number. So if you call me, text me, that's not my email here, but usually my phone is the quicker way to reach me.
We have 2 minutes for one question, which is not for the class.
Okay. Thanks, everybody. Next week, we're gonna talk about real estate marketing 101. Talk about budgeting for marketing, different types of marketing vehicles to use for marketing, what to send out, how often to send out, and so forth. So you don't want to miss that. We'll see you guys next week.
Thank you.
Thank you.
Oh, there's something in the chat.
Oh, they just said thank you.
Oh, okay.